Mr. Hayes, step away from the workstation. Keep your hands where I can see them.
Can someone explain what's happening?
Once is a mistake. Twice is suspicious. Leon Haynes did this more than 1,900 times across 2.5 years and left a paper trail for every single one.
We're executing a federal warrant involving employment tax returns prepared through this office.
I'd like to know exactly what you're talking about.
He would not get the chance to explain. Within 72 hours, federal agents would seize the office hard drives, the client files, and a 2.5-year archive of employment tax returns that federal prosecutors would later call the largest COVID-19 tax relief fraud case ever tried in the United States. More than 1,900 false returns, $170 million in fraudulent refunds sought, $55 million actually paid out by the IRS before anyone noticed. And the man who built it had spent the pandemic telling his clients he was just helping them survive. Quick question. Have you ever stopped to think about how much trust you hand over every spring to the person who prepares your taxes? Sound off in the comments and let me know. And if you are not subscribed yet, now is the time. We cover the cases that exploit that exact kind of trust every single week, and these stories do not get the coverage they deserve. Leon Morris Haynes was born in 1973 in Newark, New Jersey. His father, Walter Haynes, worked 31 years as a custodian for the Newark Board of Education. His mother, Diane, kept the books for a family-owned hardware store on Springfield Avenue. After dinner, she would clear the kitchen table, spread out the day's receipts, and post them into a green-page ledger using a mechanical pencil. Leon was the third of 4 children, and he was the only one who would sit beside her and watch. He liked the order of it, the columns, the way every entry had to balance against another entry. By the time he was 11, he could add a column of figures faster than his older sister, and by 14, he was filling out his cousin's part-time job tax return from memory. He graduated from Wequahic High School in 1991 and enrolled at Essex County College the same fall, working evenings at a Pathmark on Bergen Street to pay tuition. He transferred to Rutgers Newark in 1994 and finished a bachelor's in accounting in 1996. His professors remembered him as quiet, precise, and unusually patient with the slower students in his study group. One advisor's recommendation letter described him as methodical, dependable, and uncommonly comfortable with the granular detail of the tax code. He took his first real job in 1997 with a small CPA firm in Montclair, starting salary $31,000. He spent 4 tax seasons there, learning how individual returns differed from small business returns, how Schedule C interacted with employment tax filings, how a quarterly Form 941 became a year-end Form 940. His supervisor, a CPA named Carol Friedland, signed off his evaluations with the same phrasing year after year: detail-oriented, reliable, strong aptitude for client work. In 2001, he moved to an H&R Block satellite office in Hackensack, then to a regional firm in Englewood, and finally, in the spring of 2008, right as the financial crisis was breaking, he hung his own shingle on Cedar Lane in Teaneck. The storefront was small, a waiting area with 3 chairs, a printer that jammed twice a week, and a hand-lettered sign in the window that read, Haynes Tax and Bookkeeping. Walk-ins welcome. He built the practice slowly. Bergen County had no shortage of accountants, but Leon had what the older firms in the area did not. He answered his phone on Sunday afternoons. He explained quarterly estimated payments to clients who had never filed before. He drove to Patterson and Passaic to pick up paperwork from clients who could not get to Teaneck. By 2015, he had close to 400 regular clients on his books, a part-time bookkeeper named Rena, and an upstairs office above a Dominican bakery that smelled like cinnamon every morning. He married a school counselor named Vanessa in 2003. They bought a split level on Sussex Avenue in 2007. 2 children followed, a daughter in 2009 and a son in 2012. He coached his son's t-ball team on Saturdays at Voti Park. He sponsored his daughter's elementary school yearbook. He was, by every available account, the kind of neighbor who lent his snowblower out without being asked. His tax practice grew. By 2019, his gross billings had crossed $300,000 a year. He had begun to specialize. Small restaurants, home health agencies, daycare operators, independent truckers. The kinds of businesses that ran on tight margins and were always one bad quarter from closing. He understood their books the way a doctor understands the chart of a patient he has seen every 6 months for 10 years. And then the pandemic arrived. To understand what Leon Haynes would do over the next 2.5 years, you have to understand the architecture Congress built in the spring of 2020. When COVID-19 shut the country down in March of that year, the federal government faced a problem with no historical precedent. Tens of millions of small businesses were about to lose every dollar of revenue overnight. Payroll could not wait for a multi-month grant cycle. Sick employees could not wait for a normal IRS refund timeline. If Congress moved at its usual speed, the businesses Congress was trying to save would already be gone. So Congress did something it rarely does. It built a relief architecture designed for speed over scrutiny. The Employee Retention Credit, or ERC, was one piece of that architecture. The sick and family leave credits were another. Together, they allowed eligible small businesses to claim refundable tax credits against their employment tax liability, credits that were calculated as a percentage of qualified wages paid to employees during specific pandemic disruption quarters. The credits could exceed the business's actual tax liability for the quarter. When that happened, the IRS would send the business a refund check for the difference. The mechanism was simple. The employer, or their tax preparer, filed an amended quarterly employment tax return, a Form 941X, claiming the credit for a prior covered quarter. The IRS processed the amendment. The refund check went out. The design was deliberate. Congress wanted the money in employers' hands fast. The friction was lowered on purpose. The IRS's standard fraud detection cycle, the audit verification that normally catches inflated refund claims, was structured as a post-payment review, meaning the check went out first. The verification, if it happened at all, came later. There was one piece of the architecture that nobody talked about much in 2020 and 2021. Every dollar of those credits flowed through a single human choke point, the credentialed tax preparer. The IRS could not verify in real time whether the employee headcount on a Form 941X was real. It could not verify in real time whether the wages claimed had actually been paid. Those numbers were attested to by the preparer and by the business owner. The IRS trusted that attestation because the alternative, verifying every claim before payment, would have collapsed the entire emergency relief timeline. In Teaneck, New Jersey, on the second floor above a Dominican bakery on Cedar Lane, Leon Haynes understood that architecture better than almost anyone. He had been filing Form 941s for 13 years. He knew exactly which line on the form drove the refund calculation. He knew how the credit interacted with the headcount. He knew what the IRS would and would not check before cutting a check. And in November of 2020, he sat down at his desk after his last client of the day, opened the tax software, and filed the first one. The first false return went out on a Tuesday in early November 2020. The client was a hair salon in Paterson with 3 full-time employees. On the amended Form 941X that Leon Haynes filed for the second quarter of 2020, the salon had 41 employees and a qualified wage base 17 times larger than its real payroll. The credit claimed was just under $90,000. The IRS sent the refund check. No call, no audit, no follow-up question. The check arrived at the salon owner's mailbox 11 weeks later. Leon Haynes drove to Paterson, collected his fee, 20% of the refund, in cash, in a manila envelope, and drove back to Teaneck. He filed the second one the following Monday, a small construction firm in Garfield. He claimed 62 employees. The actual payroll was 8. The credit cleared. The cash envelope landed on his desk 5 weeks later. By February of 2021, he was filing 2 or 3 a week. By summer, he was filing 10 a week. By the end of 2021, he had brought in a part-time helper, a former bookkeeping client whose own business had folded, and trained her to enter the inflated headcounts into the software. The pattern became mechanical. The client would bring in a real payroll figure. Leon would enter a fabricated one. The credit would be calculated against the fabrication. The amended return would go out. The check would arrive. The client would hand over a percentage in cash. The clients knew, some of them, at least. Others convinced themselves they did not. Leon told them the credit was a government program, that the rules were complicated, that he was simply maximizing what they were entitled to. Some clients pushed back. He stopped working with the ones who pushed back. Word spread among small business owners in Bergen, Passaic, and Hudson counties that there was a preparer in Teaneck who could get COVID refunds the bigger firms said were impossible. The volume kept climbing. In 2022, he was filing more than 100 returns a month. He filed for his own businesses too, shell entities he had set up over the years that had no real employees at all. He filed for relatives. He filed for friends of clients. The architecture did not require him to verify anything. The software did not flag inflated headcounts. The IRS did not bounce a single return. The money came back in waves, $20,000 one week, $80,000 the next. A single refund check for $231,000 in April 2022. His cut on that one was $46,000, paid in cash in his office on a Friday afternoon. The bookkeeper noticed but did not ask. He stopped depositing the cash. He stopped reporting the cash. His own personal tax returns for 2021 and 2022 showed gross income roughly consistent with what his practice had earned in 2019. The hundreds of thousands of dollars in fees he was collecting on the ERC scheme never appeared on a Schedule C. He bought a new car. He paid off the mortgage on Sussex Avenue. He took his wife to St. Lucia. He sponsored a youth baseball league in Teaneck and had his name painted on the outfield fence. He upgraded the office. He bought his son a drum set and paid for lessons. He told friends business had been good through the pandemic, and they nodded, because business had been good for tax preparers through the pandemic, and there was nothing about the answer that sounded wrong. By the spring of 2023, he had filed more than 1,900 false employment tax returns. The fraudulent refund total claimed had crossed $170 million. The IRS had paid out more than $55 million of it. 60 fraudulent returns a month, every month, for 30 months running. And not one person inside the IRS had picked up the phone. The unraveling did not begin with a whistleblower. It did not begin with a complaint. It began with a spreadsheet. In the spring of 2023, an IRS criminal investigation analyst in the Newark field office was running a pattern detection query against amended employment tax returns filed in the New York, New Jersey region between November 2020 and the end of 2022. The query was looking for one thing: preparer identification numbers that appeared on an unusually large volume of Form 941X filings claiming the employee retention credit. The analyst pulled the top 50 preparers by volume. Most of the names on the list belonged to firms with 20, 50, 100 preparers under the same umbrella ID. Large practices, high-volume practices, nothing surprising. Then the analyst looked at the outliers, sole preparers whose individual ID numbers were attached to more amended 941X filings than entire regional firms. One name kept coming back: Leon M. Haynes. Preparer tax identification number issued out of Teaneck, New Jersey. More than 1,500 amended returns. Single preparer. Single small office. The volume was not just high. The volume was statistically impossible for a single sole practitioner working a normal client roster. The analyst pulled a sample of the underlying returns, 20 of them, picked at random. On every one of the 20, the employee headcount claimed on the amended Form 941X for a COVID quarter did not match the headcount the same business had reported on its original Form 941 for that same quarter. The inflations were enormous. A 3-employee restaurant claimed 38 employees. An 8-employee daycare claimed 71. A 2-employee trucking outfit claimed 24. The case was opened in May of 2023. The special agent in charge, Jennifer L. Hartwell, assigned it to a 4-agent team and a forensic accountant. The first month was spent pulling every return Haynes had filed since 2019. The second month was spent interviewing clients. By month 3, the agents had a list of more than 900 businesses for which the headcount on the amended return did not match the headcount on the original return, the state employment filings, the workers' compensation records, or the business's own internal payroll software. The clients began to talk. Some of them had paid Haynes 20%. Some of them had paid him 30%. Some of them had handed him $50,000 in cash across a desk in a small office above a bakery and never asked what the cash was being recorded as. The investigation went silent for nearly a year. Inside the Newark field office, agents kept building. Subpoenas went out for bank records. Surveillance picked up the cash deposits Haynes had stopped making and the cash purchases he had started making. The forensic accountant reconstructed every cent of fee income he had failed to report to the IRS. By the spring of 2024, the case was ready. We are about to get into the federal investigation and the trial. Before we do, if this kind of accountability coverage is the reason you clicked on this video, take a second and subscribe. The stories we cover here do not get the mainstream attention they deserve, and the more eyes we get on these cases, the harder they are to bury. The search warrant was signed on a Tuesday morning in April 2024. The affidavit ran 147 pages. The agents knocked on the door of the office above the Dominican bakery at 9:06 in the morning, with a forensic computer team behind them and a moving truck idling on Cedar Lane. They took everything: 3 desktop computers, a laptop, 2 external hard drives, 11 banker's boxes of paper client files, a pocket notebook from the top drawer of Haynes's desk that contained a handwritten ledger of cash fees received between 2021 and early 2024, a ledger that, when the forensic accountant reconciled it against the bank records and the tax returns, accounted for nearly $400,000 in unreported income. They found something else in the notebook too, a list of business names in Haynes's handwriting with dollar figures next to each one and a column of percentages. The column was labeled, in small block letters, "My Cut." Some of the figures were circled, some were crossed out. One page near the back held a running tally of refund checks Haynes had personally cashed at a check-cashing storefront in Hackensack. The digital evidence was worse. The forensic team pulled the tax preparation software's audit logs and matched every amended Form 941X Haynes had filed against the underlying client records he had on file. More than 1,900 returns. On more than 1,900 returns, the headcount entered on the amended form did not match the headcount on the underlying payroll data Haynes himself had saved in the same client folder. The text messages were the smoking gun. Haynes had communicated with several of his clients through a regular text thread on his personal phone. The agents pulled the device under warrant. The exchanges read like a confession. Haynes, March 14, 2022. Refund went through. $218K. My cut is 20. Cash this time, like before. Client, March 14th, 2022. Same as last one? I don't report this right? Haynes, March 14th, 2022. Don't worry about that. The credit is the credit. The fee is between us. Client, March 14th, 2022. Okay, Friday after 5. There were dozens of exchanges like it. Different clients, different amounts, same pattern, same instructions, same understanding that the cash was off the books on both sides. The forensic accountant produced the final report in August of 2024. More than 1,900 false employment tax returns. More than $170 million in fraudulent refunds claimed. More than $55 million actually paid out by the IRS. More than $400,000 in unreported personal fee income. 2 separate categories of federal crime running on parallel tracks for 2.5 years. The federal grand jury returned the indictment in September of 2024. 18 counts, 15 counts of aiding and assisting in the preparation and presentation of false tax returns, 1 count of mail fraud, 2 counts of tax evasion. The arrest happened at his home on Sussex Avenue at 6:22 in the morning. 2 unmarked Suburbans and a T-neck police cruiser pulled up to the curb. 6 agents approached the front door. Haynes opened it himself, in a gray Rutgers sweatshirt, holding a coffee mug. His wife was in the kitchen behind him, The children were upstairs. The lead agent identified himself. Special Agent David Kornfeld, IRS Criminal Investigation. He read Haynes the warrant and the charges. 18 counts. Federal indictment. The Suburbans had already blocked the driveway. Haynes set the coffee mug on the side table by the door. Agent Kornfeld, Mr. Haynes, we have a warrant for your arrest and a search warrant for the residence. Step outside, please. Haynes, there has to be a mistake. I file thousands of returns. If there is an error somewhere, we can fix it. We do not need to do it like this. Agent Kornfeld, this is not about a filing error, sir. Haynes, then what is this about? Agent Kornfeld, Mr. Haynes, you are being charged with filing more than 1,900 false employment tax returns, claiming false COVID credits, with mail fraud, and with tax evasion. We have the returns. We have the bank records. We have the text messages. We need you to step outside and put your hands on the vehicle. He did not move at first. His wife appeared in the hallway behind him. Vanessa. Leon, what is going on? He did not turn around. He looked at the agent. Haynes, I want to call my attorney. Agent Kornfeld, you can do that at the field office. Right now, I need you to step outside. He stepped outside. The agents walked him down the front path of the house he had paid off with the cash from the refund checks, past the youth baseball banner he had sponsored, past the new car in the driveway, and into the back of the second Suburban. His wife stood in the doorway with both hands over her mouth. The neighbors had started to come out onto their porches. He did not speak again on the ride to Newark. He invoked his right to counsel within 4 minutes of being seated in the interview room. The interview ended before it began. The trial began on a Monday morning in November 2025 in the federal courthouse on Broad Street in Newark, before United States District Judge William J. Martini. The prosecution team was led by the U.S. Attorney's Office for the District of New Jersey, with acting U.S. Attorney and Special Attorney Alina Habba announcing the case at the opening of the trial phase. The defense argued that Haynes had been the victim of bad client data, that the false headcount figures had come from the clients themselves, that he had no reason to doubt the numbers his clients provided, and that the IRS had paid the refunds because the IRS, too, had found nothing objectionable in the returns at the time. The trial ran 6 days. The government called 19 witnesses. 8 of them were former clients who testified under cooperation agreements. Each one described the same pattern: the cash percentage, the off-the-books fee, the understanding that the headcount on the amended return was not the headcount of the business. The forensic accountant testified for a day and a half. The agents from the search warrant testified about the notebook in the top drawer, the column labeled My Cut, and the text messages on the personal phone. The defense called 3 witnesses, 2 character witnesses and a tax preparation expert, who tried to argue that the headcount discrepancies could be explained by good faith confusion about how the employee retention credit defined a qualified employee. On cross-examination, the expert conceded that no good faith definition of a qualified employee allowed a 3-employee restaurant to claim 38. The jury was out for less than 5 hours. The verdict came back on the afternoon of the 6th day. Guilty on all 18 counts. 15 counts of aiding and assisting in the preparation and presentation of false tax returns. 1 count of mail fraud. 2 counts of tax evasion. Sentencing was held on April 8, 2026, before Judge Martini, with U.S. Attorney Robert Fraser announcing on behalf of the office. A small business owner from Patterson read a victim impact statement at the hearing. Her hair salon had been one of the businesses on whose behalf Haynes had filed an inflated return. She had paid him $12,000 in cash. When the IRS audit reached her in 2024, she lost the salon she had run for 19 years. He told me the program was for businesses like mine, she said. He told me he was helping me. I believed him because he was the only one in this country who ever told me there was money for businesses like mine. Now I have nothing. Judge Martini addressed the courtroom before he imposed the sentence. The pandemic-era credit architecture was designed by Congress to keep small businesses alive, he said. It was built on speed, It was built on trust. Mr. Haynes did not just abuse that trust, he industrialized the abuse of it. 1,900 false returns filed across 2.5 years is not a moment of weakness. It is not a misjudgment. It is a sustained, deliberate, multi-year pipeline operated by a credentialed professional who understood every safeguard he was defeating. The sentence I impose today must reflect the scale of the conduct, the deliberation behind it, and the broader public interest in deterring the next preparer who looks at an emergency relief program and sees a personal cash machine. He imposed 144 months, 12 years in federal prison, 5 years of supervised release to follow, restitution of more than $55 million to the Internal Revenue Service. U.S. Attorney Fraser addressed the press on the steps outside. Pandemic relief programs were created to support Americans during a national crisis, he said. But Haynes, a tax preparer entrusted to help people comply with the law, treated those programs as a personal cash machine. Leon Haynes was transferred to FCI Fort Dix in central New Jersey to begin his sentence. Projected release date, 2037. He will be 64 years old when he walks out. The restitution order will follow him for the rest of his life. This case was staggering, but the case on the right-hand side of your screen, what that defendant did to the people who trusted him is on another level entirely. Click it now.